Holy shit. I'm pumped because, today we have the American crypto team here today, and we're just winners. And I'm extremely excited because this has been a long time coming. We've been waiting for it, and today's the day. We have Mr. Crypto America, Sam from Frax here, and also Jim Hiltner. How you doing, man? How you doing?
Doing well, Sam. How are you? Should we get a USA chant going? Or
I think so.
USA, USA,
USA.
USA.
Actually, we've had Sam on a bunch already, Jim. So maybe before we get into the gossip from the inaugural crypto ball, maybe you can give us a little origin story about yourself.
Yeah, no problem. Thanks for having me on. I'm Jim. I run business development at Superstate, one of the co-founders with the man, the myth, the legend, Robert Leshner. So he and I and the other two co-founders, we all worked together at Compound before launching Superstate. And my background prior to that was doing all the boring bank TradFi stuff. So finally, made my way into crypto full time. But have been, I'm pretty active in fintech and the asset management world, and excited for all the stuff that we're doing at Superstate. And Sam's been a great champion of all the amazing stuff on the Frax ecosystem, and we're excited to partner with FRAXUSD coming out soon, the new rebrand. And happy to dive into what we're up to. But Sam's got some tea from the ball, so I think we should start with him.
Yeah,
You're looking fly. Sam, why don't you start? I'm going to go find the picture of you in your tux so everybody can see.
Yeah, for sure. It was fantastic. Before I say anything, disclaimer, no one knew there was going to be a Trump meme coin. I did not know. No one knew. I actually, we still don't even know if anyone knew. So no. That was not there in any alpha from that or anything. But the ball was fantastic. It was, I think it was really great to really be there. Sergey, the Chainlink founder, and then obviously one with Rob Rushi, the Move founder, and obviously the man, the myth, the legend, Robert Leshner of Superstate and Compound, the father of DeFi. And there's obviously a ton of more people, and I didn't want to spam all the pictures, but I think that the fact that this is actually how this era starts is going to be really, really great. And obviously, I would never have imagined 4 years ago if there was going to be a crypto inaugural party. And I think it's really safe to say that, I think the USA is going to be what people thought of as like Singapore, Dubai, all this stuff. And the reason for that is Frax is actually, to be honest, Frax actually is like the OG Trump, kind of sort of affiliated project. Is I actually founded it with Stephen Moore. If you go and type in Stephen Moore Frax, he was Trump's first term pick to lead the Fed. Obviously, he didn't go through the confirmation, so he went back to the private sector. He worked with us to found Frax, and the idea was that there should be a stablecoin that is, first of all, used widely, but then more integrated into the Federal Reserve System and U.S. banking. And 4 years later, this is just common, accepted, concept, right? And honestly, it's crazy to see how far everyone's come. And I was talking to Robert, and the atmosphere there was just very, very, very full of optimism and everything that's to come. And I think this next phase is really about actually integrating crypto into the next rails and infrastructure and institutions to bring the next 1 billion users in the next 4 years, right? That's on average, if it's linear, 250 million users a year. But these things aren't always linear, right? This next year might be 100 million, right? The next year might be 300 million, and then, boom, right? And I think that the reason we're really excited to work together at Superstate, and also just the ethos of FRXUSD, pronounced FRAXUSD, with this new stablecoin, is that with our experience of how everything in DeFi and stablecoins work. I think this design is the best of both worlds, and I'll obviously explain what that means. But someone actually I met at the ball, they actually asked me this question: if you could do it over again, if you could design a stablecoin over again, how would you do it, knowing everything you do now? And I was like, actually, that's exactly what we're doing now.
Yeah.
We're launching this new FRXUSD, FRAXUSD stablecoin, and it would obviously work exactly the same that we've built if we've got to do it again, which we are. And the main thing about it is, like, right now there's this thing of two things, right? It has to have safety and redeemability in tier one institutions, right? And asset custodians, right? Like Superstate, like BlackRock, like anyone else that is on this top tier of reputational level. And then two, there's the yielding component, right? So there's obviously a second stablecoin called SFRAXUSD, SFRXUSD, and that actually gets best in class yields. And I'll explain how that works. But can you actually marry these two things in a way that doesn't implode like Terra, right? Where it's like 20% in anchor, and then it's like not redeemable because it's this algo stable thingamajiggy. Or can you only have it where it's like Tether and USDC, where, okay, great, like these are pretty safe, extremely liquid. They're integrated in payment apps and all this stuff, and increasingly more and more everywhere in centralized exchanges, but they're not very much known to give yields the same way as, best in class, either the entire T-bill yield or anything close to like DeFi standards, right? Which is like lending rates and like Aave, like benchmarks, or like Athena, right? Basis trade benchmarks. Can you create something that has the best of both of these worlds without basically giving up one side or the other? Right now, it seems like there's, this or that, right? And I think with the FRXUSD design, we've managed to do it, and we're going to launch it very soon in a matter of days and show the world that. So that's why I'm really excited.
You know what's wild is you talk about the person asking you about like what you would do differently. And I think the answer is like, we have all this like knowledge now to look back and say like, oh, okay, like why didn't we just hook up treasuries and like have all these on-chain yield sources and do the basis trade? It just wasn't possible back then.
It didn't exist.
Right? It didn't exist, right? There was no way there was barely any way to get like stable coins onto, but like stable coins that you could find a bank large enough that you could keep enough collateral there that you could issue enough stable coins. And this was like for years, from like 2018, 19, 20, 22, like pretty much all the way up until 22 when it hit the mainstream. It was impossible to do. And so like the design choices that you made in the beginning, Sam, were for a reason. And it was only with these later additions that you're able to incorporate stuff like the treasury yields, and then also go out and get the basis trade and like add all these different components into it that now makes sense. But back then it just didn't exist.
No, and the only other way to get it was some of the earlier, test cases like in the maker ecosystem, right? So like you could basically be given Coinbase a bunch of your USDC and getting paid a return back on that, right? And so you could structure these deals, but you didn't have the direct exposure like what Sam is describing into an institution, basically a separately managed account that has, treasury bills that don't have, regional bank credit risk exposure to them.
Yeah.
And the counterparty risk is basically in a trust that's totally segregated from even Superstate and BlackRock and some of these other managers. And so that type of stuff did, obviously existed in the traditional space, but in terms of being able to incorporate that into something that's elegantly plugged into the Frax ecosystem and allows for minting and burning and a much more on-chain transparency, like that kind of stuff just didn't exist. And so you had to like really do a lot of trust on, who the counterparties were and like where the yield was really coming from. And a lot of that was still, being done in bank accounts, just all off chain with some attestations, versus, having like real visibility into all of that all the way through, from source to use of the capital. And this is also, I think, still just the starting point. It's the best of both worlds, like Sam described, but there's a heck of a lot of additional asset classes or yield or collateral structures that can be built in between the treasury bills and the carry trade. And so you're seeing a lot more sophistication come on chain in terms of like packaging traditional products, like whether it's longer duration treasuries, or it's additional, maybe it's investment grade or high yield credit, or it's some sort of private credit or other maybe real estate, like you name it. These things will come over time. They're not there today, but there's going to be an entirely different design landscape as FRAXUSD continues to evolve over time.
Mm-hmm.
There's like the sources that it plugs into, but like the infrastructure and the pipes are starting to be laid now.
Can we go, what's funny about, again, like to talk about Frax, like here in 2025, is that Frax has pretty much been plugged into every part of DeFi and the entire part of the crypto ecosystem for like a half decade now. And so like when we talk about all of the issues that arose during the Biden administration, we can easily point to like one thing, like the mismanagement of stablecoins as collateral that forced USDC and a Circle into concentrating so much wealth into SVB, right? Yeah. This one thing of the Biden administration going after Circle, totally legit American company doing great things, put the entire DeFi ecosystem at risk, right? Many people went out of business because of it. Some protocols blew up. I was having heart palpitations when Frax went to 92 that day. Like it was really like I had a lot of anxiety back in 2022. I think a lot of people did. But we're past that. And I think what's great now is that when we talk about stable coins or just this on-chain, off-chain connection, the bridge, it's firm now. And we're going to have an administration that comes in and essentially allows for the banks to hold collateral, allows for on-chain stable coins to be safer, to have the ability to like segregate accounts, not have exposure to banks that have been, like over lending or, have all this duration risk on their books. Right. It's just, we're in a new era, and I'm extremely excited to see what happens over the next 5 years.
Well, and the beauty of what you just described too is that you now have a regulatory environment that encourages this innovation to do it the right way. And so kind of going back to one of Sam's comments earlier, like it's really refreshing probably be in that room. And I was on my couch Friday night just having so much FOMO and scrolling through Twitter and figuring out how do I get to Trump coin and all that. But like, so I actually was doing, more productive things probably than, just sitting on a, just hanging out at the ball. But what was interesting is that when we first launched Superstate, it was extremely contrarian to build a regulated asset management business that also interacts with the blockchain. And like the window has totally shifted in the last, number of months where.
Well, Jim, can you, I don't mean to interrupt, but can you talk about like what that environment was like, who else was operating and what kind of solutions they were offering? Because like, I think it's important for people to understand the context of of how the ecosystem's changed and where you guys have stepped in for that.
Yeah, absolutely. So to their credit, Franklin Templeton was, had a registered money market fund, which is their Benji product, still is in existence today. So it's a 2a7 fund that's registered with the SEC that has a blockchain component towards it, right? Where you can hold your shares on chain, on various chains, Ethereum being one of them, Stellar being one of them, Arbitrum being one of them. So really pioneered a lot of the interaction between the crypto ecosystem and the regulatory environment. When Superstate first launched, our entire design and focus on the business is to make it extremely crypto native and not have, a legacy transfer agent, which is basically a book and records of all of the shareholders and how you process transactions and whatnot. And that is, very much a just spreadsheet holding, book entry versions of who owns what shares in what fund, and processing those, very much in an archaic manner, and trying to upgrade that technology to use the blockchain, do it very compliantly, do it very publicly, and do it in a way, obviously in an anonymous fashion, but leverage the blockchain to permit transaction record keeping, purchases and redemptions, secondary market transfers, you name it. We originally, when we first launched Superstate, went with about a 100-page prospectus to the SEC and said, hey, what do you think of this concept? And the reaction was, a lot of questions. And when you get a lot of questions from a regulatory agency, you'll always get a lot of questions. You'll never get a yes or no answer, but you'll basically just keep spending money on lawyers and kind of going back and forth. And unfortunately, that's the environment that we were in. And there was a little bit of a, you had oil and water, right? It was just hard to mix those two, just given, where things were back in 2023. I would say our decision to launch the fund with a Delaware statutory trust. So it basically, the way our products work today, they look like a ETF or a mutual fund where they have a Delaware statutory trust and auditors and, KYC and custodians and fund admins and all the things that you need to run like a registered security in the US. We built that infrastructure and just like ring fenced it to allow only institutional investors to purchase it, so that we could go back to the regulators and say, hey, remember theoretically in that 100 pages of black and white text that we said how things would work? Here's actually how it works. And here's a year of track record or more, now that we're over a year in existence in USTD, to demonstrate exactly how the operations work. What is the whitelist? And in terms of KYC and attaching shareholder records and permitting secondary transfers, like all of that is no longer theoretical, and that's stuff that you can go back and demonstrate to then ultimately take what is in everybody's hands, which is an S&P 500 or a QQQ or a short duration government bond fund, and register it as a security so that you have the right investor protections. But in addition to all of the great stuff that comes with that foundation, is then just throw a token in the blockchain on top of it to give it a lot more superpowers. And that's where Superstate is evolving to now, which is an exciting development. When we first went out to market to do this, our VCs and our early adopter partners thought like, this is amazing. But at the same time, it was around the bear market of 23 when everybody's like, to Sam's point, so are you moving to Dubai? Or are you guys going to do this in Singapore? Or what the heck are you doing, planting your flag in New York City? And super thankful to see that the regime has shifted since then. But it was definitely a concerted effort by Superstate to say like, this is where capital markets need to exist. This is where innovation needs to exist. And while we were kind of running against a headwind for a long time, that's definitely abated, and likely will be a tailwind here in the not too distant future.
Right. You guys made a huge bet in America with Frax as well, and it's definitely paying off now. So that's fantastic stuff.
So, Sam, you guys are interacting with Superstate through FinRez then on the back end, or how does that work?
Yeah. So let me explain the actual technical details of how FRXUSD actually will work. So the onboarding, right, of things like Superstate's USTB and their USCC, their carry trade, is entirely like compliant. Yeah, an entity has to be onboarded. However, there's a big difference. What we actually do is that there's a mint redeem contract for every type of asset that can actually mint FRAXUSD, right? And that includes like BIDL, USTB, all this stuff. And then governance approves that. And obviously we go through the compliance to actually initiate that system. And anyone that's actually able to interact with these tokens, some of them are whitelisted, right? And like, correct me if I'm wrong, right? Both like BIDL, Superstate, all this stuff, they're securities. They're registered securities with complete safety, bankruptcy remote, entirely regulated products. And so they have to have different kinds of regulations to interact with them, right? However, these assets are held in like a mint redeem contract for FRAXUSD on chain. So if you are an entity that's onboarded to any of these, right? Like let's say if you have a BlackRock account, if you have Superstate account, if you have, future custodian accounts, you can actually burn FRAXUSD and get out their representation of an asset custody by them. And then if in the other direction, if you place, USDB, or something else, BlackRock, BIDL, or whatever, you can get out FRAXUSD. Or for example, Ondo is onboarded, right? And they have a relationship with BlackRock. And so this actually allows this to be a situation where FRAXUSD is mint redeemable, right? If you have an account, the same way if you have an account with Tether or Circle, you're able to mint redeem. This is actually fully on-chain, auditable, and also onboardable to multiple places, right? Like, for example, if you can't get an account with Tether for whatever reason, or like Circle has like increased its requirements to like institutions only, if you can't get an account with those, then too bad, you can't redeem USDC, right? You have to go through Coinbase. Here you actually have a lot of different essentially jurisdictional or custodial choices, and it's actually pretty powerful because let's say someone prefers to have a relationship with BlackRock, they can actually mint redeem through there. If they prefer to have a relationship with Superstate, then they can mint redeem through there. And overall, I think this is probably the way that I would say is the optimum way to design a stable coin that's mint redeemable. And then the second part of that, right, is if you take the FRXUSD and stake it in the staked FRAXUSD vault, where all of the yield is distributed to these token holders, right, as FRXUSD holders, then those FRAXUSD stablecoins get sent to the yielding locations, right? Whether they get sent to USCC, or like we have a relationship with Athena and their carry trade pipeline, right? And the really interesting thing is, at the beginning, that FRAXUSD might have to be converted temporarily to like USD from Athena, right? Or like Superstate might have to convert that to cash to run their carry trade. However, as FRAXUSD itself gets integrated in like centralized exchanges or in different perp markets, and a lot of different places that fiat coins and redeemable, highly safe stable coins are in, you don't have to actually change out of FRAXUSD, right? You can actually just send, for example, that FRAXUSD to Superstate for USCC, and they can actually use that as collateral to do their carry trade. Or you can actually send it to somewhere else that actually has the benchmark DeFi yields. In fact, one thing that's a cool idea, we haven't really talked about this, Jim, but like something that I've thought of is for Superstate to have like a DeFi on-chain yield benchmark like product, where it's like the Aave and Compound benchmark rates of like very safe stable coins like USDC, USDT, FRXUSD. You can always get those because that's essentially a managed and professionally managed product. And so once Frax USD is in Aave and Compound, literally that yield can actually be transferred over to SFrax USD holders. And so you have this yielding stablecoin that underlies a very safe, redeemable, multi, custodian, tier A custodian, bankruptcy remote system, but it's yielding the best benchmark rate. So you can actually stake and forget, right? And know that you have the best risk-adjusted, obviously, not riskless, but risk-adjusted yields in the entire industry. And you can know that, for example, if the carry trade is yielding very high, USCC and like Athena will back and bring the yield to SFrax USD. If that's not the benchmark yield, and for example, if Superstate has like a DeFi product, right, where it's like in lending markets, those are the best yields, you'll get those too. You don't have to go and unstake it and go and lend or do any of these things. You'll know that. And like we were talking about before, during the worst of the worst, during 2023 and the bear market where everything was kind of dead, and T-bills were the highest yielding product, at worst case, you have this floor yield of the risk-free rate of the dollar, custodied by tier one, best of the best institutions, and you get that T-bill yield, whatever that might be in that market. And so you know this system works, it's structured properly, and it's entirely best in class for both yields and also best in class in terms of redeemability, right? And that's what's really important. That's the best of both worlds design that I keep referring to.
So you guys are shifting from a singular collateral, like just to go through some Frax history, right? You guys started out, there was one collateral type that backed everything, that was USDC. Then you guys started to work with your AMO, so the algorithmic market operations. When you use the AMO, you're swapping out the USDC for other types of assets that would like go on your balance sheet. So maybe it's some USDT if you're putting it into an LP with USDC or whatever type of stable coin is out there. Then I think, just to bring it back to what I was talking about earlier with the SVB collapse that affected Circle, you guys figured out that, oh, okay, well, we got to have like a more diversified like core collateral set, and treasuries are the best way to do that because yields are back and it's a different environment than we were in back in 21 and 22 or 20 even. And so the addition of these products, whether it's Superstate or BlackRock or anybody else, is really there to diversify the balance sheet so that there is no one asset which could have systemic risk for the entire protocol.
Well, I would actually go even a bit further than that. And I would say, so the main thing that we learned is that literally, like, as everyone knows, like we're a very long-term oriented team. We're going to be here for a long time, like Ethereum, right? And like all of these projects that are thinking decades, right? And I honestly think that in the next 10 years, multiple stablecoins will be multi-trillion in market cap. And so what we were thinking is not just about, we were thinking bigger, not like diversifying collateral. We were thinking, look, in order to actually get institutions, credit cards, banks, and all of these places that will be onboarding the next 1 billion people to crypto, what kind of stablecoin will that look like? And if you think about it, we already know the first thing, and this is my view, is it has to be redeemable in kind at 1.00 for cash always, right? And that's why USDC and USDT are everywhere. If you, for example, let's say like Visa integrates USDC, right? And so like let's say like another let's say Amex, like another credit card provider or something, right? If they want to integrate a stablecoin, they can't be like, oh, DAI or Frax or something. How do we get okay, so it can't be redeemed. Where's the price? Like, well, we need to look at how can I sell this? What does liquidity mean? If my customers want to come in and out, you have to be able to actually like know that this thing represents $1 of cash equivalent, like professionally custodied assets at all times. You can't onboard institutions or like the next 1 billion people in funnels that have all these users, credit cards, banks, centralized exchanges, all this stuff. If they're like, you have to look at a Chainlink Oracle, or like, oh, there's not enough curve pool liquidity in this thing, and blah, blah, blah. That's why you see like DAI and Frax, the legacy, Frax dollar, right? They're not integrated in these locations, right? It's USDC, it's Tether, right? And like, it's not about the exchange wants to make money or has some kind of deal. Sure, that too. We, those DAI and Frax and stuff could sign similar deals or something. It's not about that, right? It's about the fact that if you need a representation of the dollar in a digital cryptographic token and a non-custodial token, it has to be redeemed interchangeably for the actual physical dollar. Otherwise, it's not going to actually be used in a lot of places. And that's like an empirical fact, right? Like you could maybe disagree, but you could then look around and see that's why decentralized stablecoins only work in actual on-chain places, and very few places ever integrate them. Like most of the places that might do it, like I think maybe Gnosis Pay does it, like with DAI or something. They're exceptions to the rule. They're not like counterexamples of a prevailing trend. And so that's the thing that is very important, is can you actually create a safe, real representation of the dollar while also not giving up the, on-chain best-in-class yields, and also the DeFi ethos that Frax, is one of the founding like staples, blue chips, and so like that's what the design is more about, rather than we need to diversify the collateral because like this one time Circle really screwed up and put a lot of their deposits in like a highly leveraged bank, and the FDIC had to bail them out and stuff, which that solves. But it's really crucial to if Frax USD is going to be 1 trillion in market cap in the next decade, it has to look like this. That's the main underlying thing. And one last thing I will say before is like, what's actually even more valuable about this design is you actually get an additional alignment of incentives, where because you can actually work with tier 1 institutions and custodians like Superstate and others, there's actually an incentive for both of us to succeed, right? Because if, for example, Superstate helps FRXUSD get integrated in the location that they do the basis trade, right?
Mhm.
That's great. That's more FRXUSD demand. And where do you think the custody of the assets that this is going to go? It's going to go to Superstate, right?
Yeah.
So unlike the designs where the fiat coins entirely are fused into both a custody solution that's managed by the issuer and the cryptographic representation is also managed by the issuer, we've decoupled that where we are the kind of issuer on the blockchain and the tech, and we've separated the actual custodial relationship of minting and redeeming to and from real dollars to extremely professional teams that know how to do that stuff even better than we do. And we work on this part of it rather than fuse them together. Because if that was one unit, right, then it would be where no one has a real incentive to use like Superstate could just use USDC, right? If they knew that FRXUSD just custodies its own thing through its own system, it would actually just break the alignment of incentives, right? It would just be a customer relationship rather than a customer growth relationship where when one side grows, the other side also necessarily grows. So.
What a way to flip the script, right? Because like, I just want to take people back and we can talk about how Frax was designed in the beginning, where the whole point of Frax was that like if it went a cent above the peg, then Frax could mint more Frax, right, and balance it out. Or if it went under the peg, then it would balance out. And then we shifted into AMO operations, which again allowed for that type of arbitrage to take place at the protocol level. But now with the introduction of Superstate and the other partners that you talked about, it's no longer the protocol's responsibility to figure out how much FRAXUSD there should be in the system. You guys have been reading a lot. I don't know, I don't know about you, Jim, but Sam, it sounds like you've been reading a lot of like Gary Gorton, Jeffrey Zhang. You know, like the most important thing that money is this like no questions asked, has to be redeemed at par for whatever you have. And for institutions like Superstate and the others, that's incredibly important. Like if I have $10 of FRXUSD, can I turn it into $10, right? If it's even 1 penny less, then it completely throws out the entire assumptions that you have to make about this asset. And I think, you know, just hearing what you've telling me, this has been one of the biggest criticisms of stablecoins for the past decade since they've existed, is that they don't satisfy this no questions asked. They're just private money that people can't rely on. Sometimes they depeg. It's really difficult for anybody to determine how they should pay for things, right? Because if everybody's saying like, well, I have this stable coin where it's like, you know, half a cent less, and you have one that's like a little bit more. Sure, we can use AMMs, but it's not something that you can use at scale, and it's not something that institutions would want to, or companies would want to use or put on their balance sheets. So this seems like a radical change towards taking what's demanded by the traditional finance system, which is this NQA principle, and then merging it in with all the best parts of what has been built on DeFi over the past half decade.
Yeah, as the world's first self-proclaimed stablecoin maximalist, I've read a bunch of stuff, like you said, about it. And so for people that don't know, the no questions asked policy is essentially, if you think about it, like all of bank deposits, everyone's bank, like, you know, you might use Wells Fargo, Bank of America, Chase, or whatever. They're all interchangeable because of the FDIC and this guarantee that, like, if you have money here and you send it there, it's basically the same thing, even though all of the different banks take different risks. They make different loans to like different mortgage providers and like people and stuff like that. So they technically shouldn't necessarily, right, like be exactly the same, because just like stable coins currently, right, they should have like something should be 0.997, or like the one that's really, really safe should be 1.00. But the FDIC and the government regulatory system actually formalizes this so that things can work in the traditional financial plumbing, right? Like for people that haven't really thought about it, right? It's like, these are all different private banks, right? And this is probably part of why some people come up with the issue of like, banks have socialized losses, but privatized gains, because in order to really get this going, right, the FDIC has to actually, bail out banks that have a problem, right? And the interesting thing with like FRXUSD is we actually create this in the open market with all the enshrined custodians. That doesn't mean everyone can be an enshrined custodian. It really has to be tier one top institutions like Superstate, like BlackRock. They have to be bankruptcy remote. They have to be a very, very reputable, Lindy brand. They have to be all of these. And then like you were saying, Sam, is like, if all of them can prove they have a custody of $1 assets, they can mint. And then they can also burn FRXUSD and release that representation and take it somewhere else, right? Or even between them. And so you kind of create this FDIC sort of system of enshrined custodians between FRXUSD, and then the representation of that money is the stablecoin, right? FRAXUSD that flows across everywhere and then shares that liquidity, right? The whole point of money is it's highly liquid and you can use it in multiple places and it's accepted as payment in kind, right? Like with no questions asked. And we try to solve that part. And then we actually delegate essentially or give full responsibility and sovereignty of custodying the back end to entities like Superstate.
I think what's interesting too is if you look past like kind of this initial launch, when Superstate, as I mentioned, it's just institutional only. There's a limited set of minters, if you want to call them that, or relationships that Superstate can onboard, or large institutions. There could be market makers, it could be liquid funds, it could be family offices, it could be protocols themselves. Like they just have to be entities and institutions. As we like go and open up the addressable market for folks that can come to Superstate and say, I want to invest in this fund because of all the properties that, in terms of capital preservation and yield and the dynamics about the technology that USTB and USCC offer, those are great investments for me. I want to be able to deploy some of my cash or savings into that product. I can then go to Frax as an individual at some point in time and mint FRAXUSD, right? Like Sam is not going to be restricting anybody to be able to interact with Superstate to mint FRAXUSD. Like now, all of a sudden, you take a savings product that you had that otherwise would have sat in a JP Morgan account or something like that. And as long as like these are being minted through a proper custodian, I can take those assets and I can go mint a stablecoin and do a whole bunch of other stuff on chain, or I can send that to make a payment or do something that otherwise would have just sat in a brokerage account doing nothing. This is where DeFi distribution becomes really interesting, and you can now start to compound the use cases for the assets that otherwise didn't interact with anything else other than minting and redeeming them for yourself, and then going back to cash, waiting a few days to then go buy a coffee with it. So like the landscape that opens up and just the addressable market, whether it's here in the US as large institutions, or it goes internationally with other large institutions, or it goes retail and much more global, and the user base underpinning this ecosystem just dramatically increases. And like we're starting very small, and like I agree with Sam's roadmap. Like we're gonna take very concerted efforts to like grow DeFi in very measured ways. But like once you hit the moment where people start to realize that they're not getting the utility out of their own balance sheet that they can if they're using blockchain-based systems and these types of structures that are put in place, it's like, why would I do anything the way I used to? I look at the wave of 2022 into 23. It was more predominantly like the beginning of 22, when you had all these neobanks that were like, we don't have enough interesting things to do in TradFi. We need to like get hooked up to DeFi as much as we possibly can so that we have better yield, or like a quicker payment, or like new assets to allow our investors to trade or to save.
Jim, you can be honest here. It was like, let's start a neobank so we can hook up to Anchor and get these juicy 20%.
I mean, that was part of it. Like we ran Compound Treasury, which was an institutional product. Basically, we would face off with these neobanks and we'd say, hey, we'll pay you 4% interest on the USDC that you lend to us. And we have a B- credit rating, and 4% sounded great when interest rates in treasuries were at 0. So the delta between the two of those was large enough. Now it's kind of silly because Fed funds rate is above 4%, and obviously that's not B- paper. But I think what I'm trying to get to is like, I really think that like the neobanks of the future are not coming from Web 2 into DeFi to say let's use those experiences. I think like what Sam is building is the new neobank, right? Like you you can bring your assets into a protocol where not only can you spend and mint, FRAXUSD and be able to use it in all these great ecosystems to go out and lend it or trade it, or use it in a game on certain protocols that FRAXUSD is supported, or as an institution I can use it to settle trades or use it as collateral or whatever it is. It's like, then I can go and just put it in savings, and I can just park it into staked FRAXUSD, and then that's going to pay me a yield based off of the optimization function of T-bills, carry trade, DeFi yields, and a whole slew of other things in between. That's a neobank. That's what a lot of these guys were trying to build back in 22. And then, now it's like the interface and the experience that you can do this all through your wallet is basically, avoiding you needing to use a TradFi system in that, legacy world that I was just talking about, which is kind of cool to see these two come together.
Yeah. There's do you guys listen to Macro Voices at all? It's a great podcast. One of my favorites.
Check it out.
Yeah, one of my favorites. But the host wrote a book called like Beyond Blockchain. This was like 3 or 4, maybe 5 years ago. And he talked about that the real opportunity in crypto is not stable coins. It's not Bitcoin. It's for these institutions, governments, to figure out how to tokenize treasuries, or like tokenize like bonds in a sense, and bring them on chain and have them freely tradable. Because when people complain about like the dollar or like the fiat system, like really they're complaining about like issues with the Eurodollar and like the problems that have arisen over the past 20, 30 years. And I think I've come to the realization that like what we're building here, and especially with you, Sam, is what you're building is like a hopeful replacement for the Eurodollar system that brings a greater amount of transparency. And this looks like to be like one of the first steps towards getting like innumerable, pretty much every single institution in the world onto crypto and plugged into a stablecoin, which would be something like this design with Frax, where you can have all these banks that have all these different loans, all these different collateral types plugged into one system, and having an asset that they can freely trade back and forth, and having a yield source in the back end, so they can add that too. Because sometimes it's loans they want, sometimes it's collateral they want, and the shifting dynamics of that can be directly built out by Frax and what you guys are doing at Superstate.
Yeah, and actually, one thing Jim said that I want to re-highlight, because I think it was very, very well said, which is like right now you have these kind of sort of dead assets, like in brokerages, like Charles Schwab, or things like T-bills, or like and bringing them in a custodied way to like Superstate and then like BlackRock, and then being able to create a highly money-like representation of them in FRAXUSD, and being able to do things with them in this completely new digital economy actually brings so much efficiency, monetary premium, and value that it's hard to quantify, because the asset already exists, right? Like the T-bills already exist, or like these things already exist in like a brokerage account, but you really can't do anything with them other than sell them for cash, and then it gets wired into your bank account, and then you have to mint USDC, right? Or Tether, and then you could go do stuff. But now if you just actually hold them in a custodian that's onboarded to FRXUSD, you literally can create FRXUSD in your wallet and then go do stuff with it, right? And that's really, honestly, it's a different design than, so Jim said it really well, which is it highlighted how different of a design, even though it subtly kind of looks to say, oh, it's a fiat coin that has, fully backed and blah, blah, blah. It's not. It's subtly different, both in terms of the alignment of incentives of the custodians, and also the value that it creates. And the most important thing that I think kind of gave me an aha moment a few years ago that kind of led to this design is like, a lot of people used to say, oh, Apple, like there was a time in crypto where everyone thought, oh, like everyone's going to use their token as like money, right? Like Apple would use its stock in the App Store if it could. And there was this, like, I always had this view that like they don't do it because people want the unit of the USD, but actually I think there's a second reason as well, which is that the securities laws actually prevent any other kind of utility of anything as money other than raw cash represented as CDs, certificate of deposits in banks. And I'm not saying it's like a conspiracy or something, but it's just how the actual traditional financial plumbing and structure is. I'm not saying there's like, they're like, oh, we must like stop this, but the way that it works is like, you know, anytime a stock is in any way priced in any kind of meaningful like money or meme or like non-DCF PE cash flow way, like GameStop, like all of these, right? The SEC puts out a bulletin or like, we're investigating. We might like, you know, like charge people and stuff. So basically says, stop doing that. This is not supposed to be traded as anything other than people doing DCF PE, like cash flow spreadsheets and like, you know, making analyst publications about like how much it's worth, and like people can guess whether the analyst is right, high or low. If they think it's worth more, they buy. If they don't, they sell and stuff like that, right? And so the way that the securities laws actually work, and you know, I'm not going to ascribe value whether it's good or bad or whatever, just saying it as a matter of fact, is like only cash as certificate of deposits in banks can function as anything like money or utility in anything. And because of the way that like stocks, treasury bills, all of this stuff is like custodied, and like the physical stocks are in the DTCC or whatever it's called, the Depository Trust Corporation, right? And like that's where like the physical paper certificates are, and then they have to settle with the brokers and all this stuff. You can't use this stuff as money. Even if Apple wanted to, even if tomorrow like Tim Cook had a meeting and was like, actually we're gonna you know, everyone's doing awesome stuff, like Trump just launched his meme coin, we're gonna launch Apple token that represents a stock or something, they can't do it with their stock. They would have to actually create ironically like a meme coin.
Yeah, exactly, that has no value to it whatsoever, yet that's, you know, for, you know, seen as
exactly. And so what like FRAXUSD basically does is it breaks that like wall for cash-like instruments. And to be honest, so does the fiat coins. That's the innovation of stablecoins, right? But then this does it in a two-part system, so we can actually partner with great custodians like Superstate.
Can we talk about the way that SFRAX gets the yield, right, and how you guys choose? Because from my understanding right now, it's still the protocol which is deciding like, okay, now we're doing treasuries, or we're doing basis, or we're doing like on-chain lending. Is there a way to create a which I think is a fine system, right? But seeing as you're like the Uber mechanism designer for DeFi, Sam, is there anything that could be taken from like FraxETH v2, where you have this like lending system where people can like borrow out the assets and go farm with it, right? Is there anything that could be done with like that if you had like a whitelisted set of people like Superstate, and it's up to them to be competitive about who wants to borrow it the best, and then you almost have like a quasi, like you're selling USTs at that point. You're like selling treasuries.
That's a good question. Maybe that's what V2 should be like FRAXETH V2, right? But the thing with yields that I've come to realize, and I think a lot of people now agree with, that there's a lot of empirical, you know, evidence, is like there's essentially three, and I call it kind of the three-pronged strategy, which is like there's three yields. Obviously, credit to Athena, they formalized this third prong of carry trade, that in bullish times, very few things can beat that. It's a fully collateralized system, right? And it's actually a very high yielding system. Now, not obviously all the time is the market so bullish that they're willing to pay carry yields of like 20-30%. Sometimes it's actually low, right? And the second prong is DeFi yields, right? Things like borrowing in tier one places like Aave, Compound, Fraxlend, safe, you know, known blue chip protocols. And those yields range anywhere between 7 to like 20%, right? And those are very useful, right? And so without having to micromanage, like moved into Aave and Compound and Fraxlend or back and forth and stuff, it would be great if someone could tap into that as well. So like that's like a second prong. And the third one everyone knows is the T-bill prong. And I think every kind of market condition, now that we've gone through the full gauntlet, we've gone through zero rate period, we've gone through extremely awful FTX collapse, high yield, bank collapse, SVB collapse period. And then we've also gone now through to euphoria. Holy crap, the president is launching his own token. We're all going to be insanely like rich, like euphoric period, right? So it's like literally the full gauntlet of this stuff. And I think it's safe to say these are the three prongs, right? I think that this is there's not like a fourth dimension or something that has like some other financial thing that's not discovered in stable.
I would push back on that a little bit, just because from my vantage point, we have a really interesting view on both sides. Like Superstate definitely straddles, coming from Compound, but also building an institutional asset manager. We have like a really good view on capital that's looking to be allocated from the crypto ecosystem, whether that's in products like FRAXUSD, whether that's a foundation that doesn't have access to a bank account that wants just T-bills, or there's a protocol that's looking to embed, the carry trade in a different way that we can run it than they can. And that is like, leveraging, on-chain capital that already exists and deploying it into, traditional assets. The other way around is actually, I think, even more interesting, which is taking the off-chain capital and bringing it into the digital ecosystem, into the crypto ecosystem, because like there's a ton of opportunity in DeFi, as you describe as like one of those pillars that traditional allocators just don't have access to. And like when we ran Compound Treasury, again, like we had 300 million in assets and we paid people 4%. They were like just licking their chops to get 4%, but they didn't want to touch Compound directly. So we gave them this interesting mechanism to do that. And I think that like that's also an opportunity for a smattering of structured products that can exist for bringing off-chain capital into a vehicle that looks very similar. When you go to your investment committee and you say, we're going to invest in this fund or in this product, it looks very similar to things we do in the long-short equity space and the private equity space and the private credit space. But like they just happen to deploy their strategy in a crypto native ecosystem to generate yield. That's super interesting. And then, when it comes to Frax, like I think existing exposures today are T-bills, DeFi yield, and carry trade. There's a lot of other assets out there that Frax could benefit from that maybe are like short duration, private credit, high quality lending opportunities that bring capital and get exposure to the traditional world, where like maybe these are mom and pop shops that have really great underwriting that's done to figure out whether or not they're like, receivables based finance makes sense for, lending to this particular, portfolio of small businesses, but they generate a 12% return. And that might be better than the volatility in the crypto ecosystem. So there's a lot more, I think, that can be brought on. Like while have the three different verticals that you talk about today, there's probably an entire spectrum across the board from, risk-free to carry trade that could, be brought on chain and will be brought on chain, I think, in the next, couple of years.
I want to push back on that and say that like there's been many stablecoins to come out and like try to have a mix of diversified assets that introduce like some duration risk or depend on assets that are just a bit or less illiquid than USTs or carry trade or whatever. The reason that Sam talks about those three prongs is that those are the most liquid ways to like retain cash in 2025 on chain. There is no substitution for those things. You can wind up, you can wind down that carry trade super fast, right?
Sure.
You can take money in and out of Compound just in a couple of transactions, right? Same thing for UST. The UST market is big enough where if you need to sell $1 billion in one day, like you can do that and it can absorb it. But what I've seen and what I'm always hesitant now is that I think this like kind of like leans into what like Sam's like conservative viewpoint in all of this is that as soon as you have these other types of credit, like it will get tested and it's going to get tested at some point. Like we've seen the fire and the flames that can appear in crypto. And what I think that people forget is that like, unlike a bank that might be happy to take these type of credit products onto their balance sheets, there's nobody coming to bail out Frax in case anything happens, right?
Sure.
Banks have this like implicit guarantee. They have an implicit put from the Fed. It was like, okay, go out, run your credit books, you make the economy work. If anything goes bad, we got your back, right? We don't have that. And so I think that when you're designing these types of yield systems, you have to take that into account, where it's like nobody's coming to help. If things go bust, we're all going to zero. So we don't get a second chance.
Yeah, so it's good that we're disagreeing a little bit and back and forth in the final parts of this talk. And I think the point that you raised, Sam, is right in terms of the zero duration liquid opportunity, right? In fact, there's room for maybe additional yielding products. In fact, this is even a discussion like another episode, but as people know, we have Frax bonds, which have different maturity dates. And these are essentially kind of like treasury bills of like the Frax nation or ecosystem. Obviously, they're not literally from the US Treasury necessarily, right? And so you can back those with like more illiquid type of things, and people can see what the yield is, right? And that's actually a perfect thing for what Jim is saying. In fact, over the coming years, as more and more, like you're saying, capital actually comes on chain, maybe it makes sense to actually back 5-year duration Frax bonds, FXB 2030 or something, with a package of loans, and that doesn't come due for 5 years, right? And then people can buy that and have exposure. And that's actually very cool. Maybe it'd be backed by a Superstate type of package thing. But for the USD stablecoin, right, it essentially represents cash in kind, right? So that always has to be something that I think, is like very, very touchy in terms of safety.
Well, I don't think Frax has had any of these issues yet, but I know some other stablecoins that exist in the Ethereum ecosystem have had defaults on these type of private credit loans that have been made, right? And when you don't have the 5 years to lock people in and maybe like reassess or try to find a better source, or at least get some of that cash back during that time period, it really can affect the balance sheet. Thankfully, everything's been very small.
Not just a duration issue, that's also an underwriting issue as well, too, right? And so like I'm not suggesting that stablecoins with the liquidity profile that they require necessarily mean that they should be backed in a material way by illiquid assets. Not at all saying that whatsoever. What I'm more saying is generalizing the ability for certain products on chain to be able to be backed by things like alternative assets that might have a different duration profile, or might have like, maybe there's a locked up version of something that has a 5-year, and then the ALM matches, right? The assets and liabilities match. But that type of, incorporation of alternative assets that come into this ecosystem then create a service area for Frax and others to create other products outside of just the, near term, short duration, highly liquid stablecoin space.
So we got one last question to wrap up at the top of the hour, and this one's for you, Sam. This is from Dimitri Orga, who asks, "Are we going to see a Fed master account for Frax in 2025?"
Yeah, that's always the original North Star, which is why we were working with Stephen and working with people that have experience. In fact, I can't like say anything right now on the thing on this episode, but it would be very, very cool if like we make one of the Enshrined custodians literally the Federal Reserve master account system. And that would actually, honestly, after November 5th, I think that's very, very possible sometime this year. But not saying anything, not saying it's a forward-looking statement or investment advice, but we are continuing to work on it indeed. So
it's okay. We know the backroom conversations that were taking place at the Crypto Ball. Very cool. I want to thank you guys for both coming on. This was great to have a chat. I'm really excited about this edition for Frax and how Superstate is enabling that. I think that like if you are a student of money and try to go out and kind of understand credit, it's another thing that kind of like makes sense, right? Like it's another mechanism design that really is just going to further everything that Frax has done so far. And Sam, I don't know if you're a stablecoin maximalist. At this point, you're like a balance sheet maximalist, right?
No, I mean, I'm a money maximalist in the sense that I think that, the one-liner for Frax has always been the decentralized central bank, right? And so the thing that always guided me, and then I think currently like the community that's very DeFi literate and uses this plethora of products from the Fraxel chain to FXBs to all of this kind of system that honestly resembles like a digital nation, which is why some people call it like Frax Nation, is like you have to actually think of economically sound ways to create long-term stability, long-term money and liquidity, and then obviously there's a certain asset token for us. It's Frax shares, FXS, and stuff that is a volatile value, accruing asset and a scarce asset. But the most important thing is how do you create good money, right? And whether that's through a stable coin or that's through being able to redeem it or not, and things like that, it's all part of the stablecoin science, I like to say. And so that's what I'd call myself, as a stablecoin scientist or a money scientist.
He's in the lab.
Yeah.
Always.
Well, Jim, Sam, thanks so much for being here. This is awesome to have this chat. I'm leaving a lot better. I mean, like coming into this, I don't think I was fully informed on everything, but after going through this and understanding everything, it makes me much more excited for 2025. Like really genuinely, because you guys have solved some of the most persistent and core issues that critics have thrown against stablecoins, and this seems like the most logical next step to kind of match and meet their criticisms and build something that's amazing for DeFi. So
very excited. Thank you, Sam, for the opportunity. And yeah, everybody should stay keep your eyes on the screens of like where FRAXUSD goes, because there's a lot of really exciting stuff happening.
Yeah, thanks guys, and we're really excited to work with you, Jim and Robert, and it's going to be a fun Q1 and probably even funner rest of the year. So thanks so much.
Amazing. Thanks everybody. See you next time.
All right. Thanks guys.